Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. As always, I'm excited to be here with all of you. Especially we're in 2019. We're actually in the middle of tax season. So I'm extremely busy doing tax planning and tax preparation for many of my clients. But then again, I always like to take a little bit of time every single week and share some ideas and some of the experiences that I gather along the way, and all the experiences that I have had in financial services and tax planning and insurance and alternative investments for the past 30 years. This coming Wednesday at 6 p.m., I'm going to be hosting a webinar online, and it's going to be live on Facebook Live on how to distribute your IRA and 401k tax-free in retirement. And I think that's very apropos because of the fact that we happen to be in tax season, and again, it's 2019. As you all know, under the tax law, the new tax law, we only have a 7-year window in which to maximize and prepare for retirement because of all the different issues and concerns that we're going to have to deal with in the very near future. So, I'm excited to be able to bring that to you, to the table. Now, because of the fact that I'm going to be covering this webinar on Wednesday, I felt it was a good idea to kind of give you a preview as to some of the topics that we're going to be covering. So I'm going to get to it because I don't want to take a tremendous amount of your time today from a business perspective. Now, as many of you know, we at Cambridge and at Gables Tax Planning Group, which is two of the firms that we own, we do tax planning, insurance, and alternative investments. Now, the vast majority of the clients that we engage for the first time come to us through a tax planning approach. Either they want us to audit their tax returns for the last 1 or 2 years. They're looking for some advice on tax planning. They may also be looking for additional information as to how to reduce their taxes in retirement, and many a times even in the current year. So along those lines, obviously, we provide a lot of information, and the auditing process that we do for our clients is second to none because of our ability to be able to do tax forward planning along those lines as well. Now, obviously, one of the things that we always discuss with many of you on these podcasts and seminars and webcasts and webinars that we do along with the one-on-one meetings that we have with potential clients and our existing client base is that, it's very important to have a clear vision of what a perfect retirement plan should look like. Because if you don't have a clear vision of what a perfect retirement plan should look like, then chances are you're never going to get there. You can't hit a target that you can't see. So obviously for us here at Gables Tax Planning Group, a perfect retirement plan would include guaranteed income, longevity protection. We want to make certain that income is going to last for a lifetime. Inflation hedging, because we know that inflation is a silent killer, so we always want to make certain that our income is staying ahead of inflation so we can maintain the purchasing power of the goods and services how we want to purchase from 1 year to the next. It's got to be tax-free income, or as much of it as we can possibly generate and as you can possibly generate. This perfect retirement plan also has to have long-term care hedging. Because of the fact that people are living a lot longer today than ever before, yet because of the susceptibility of living a long life, there's a higher susceptibility to living with a disability like, a long-term care necessity, Alzheimer's, Parkinson's, stroke, having the need to enter a nursing facility or an assisted living facility or whatever that may be. So it is very critical that the perfect retirement plan does provide some long-term care hedging along the way. And then last but not least, it's got to be able to provide survivor protection because, if you're married filing jointly and you're a husband and wife, you want to make certain that, upon your demise, that your surviving spouse can maintain his or her standard of living and be able to maintain their ability to be free and not be dependent on anyone from a business perspective. Now, one of the questions that I get often from many of my clients and many of you that send in your questions to us, and again, thank you so much, for participating in what we're trying to do because, we are changing the financial world one client at a time. So I'm very proud of the fact that we're devoting a tremendous amount of time and responsibility because we feel very responsible for what we do every day in trying to make certain that we can better your lives not only now but also in the future. Now, one of the feedback that I get from many clients and some of you is that you feel that you may very well be in a lower tax bracket in retirement. And my answer is always the same. The only way you're going to be in a lower tax bracket in retirement is if you happen to be a financial failure in life. And if you're a financial failure in life, then yes, you may find yourself in a lower tax bracket. But the vast majority of the clients that I engage or the new people that I engage and potential clients are seldom going to be in a lower tax bracket in retirement. And the reason for that is that taxes are going to have to double in the future or our country's going to go bankrupt. And the future, I'm not talking about the distant future. I'm actually talking about the not too distant future, like anywhere between 8 or 10 years from now. Now, we all know that the new tax law sunsets on December 31st, 2025. So that means that although we're actually living in one of the best and the lowest tax brackets in the history of our country, when it comes to January 1 of 2026, taxes are immediately going to go up. They're going to go back to the old law that was in effect in 2017. So for those of you that are looking at your tax planning today for 2018, this is going to be the first year in which you're going to be filing your taxes under the new tax law. So hopefully, for most of you, you're going to be able to see some benefits and tax benefits along those lines. Now, the other reason why you're not going to be in a lower tax bracket in retirement is that the vast majority of deductions and exemptions that you were benefiting from while you were employed and putting money away for your retirement plan are going to pretty much go away at time of retirement. So, for instance, mortgage interest, if your home is paid for or close to being paid for by the time that you retire, then chances are either the mortgage interest that you're going to be paying is going to be minimal compared to what you were paying 15, 20, 25, or 30 years ago, or you may not have a mortgage at all. So you're going to lose a deduction. Your children, that's another major deduction because many times your children not only are a deduction or have been not only a deduction but also a credit to you, from a business perspective. So you're going to lose that. Obviously, you hope that your children are not going to be home when you retire, but even if they were, then obviously they're going to be so much older than that the IRS is not going to allow you to take a deduction or an exemption or a credit for them either way anyways. Qualified plan contributions, while you were employed, you were taking money out of your income and deferring that into some kind of a qualified plan, whether it was a 401k or a simple IRA or a SEP or an IRA, you were actually deferring the income. But when you were deferring the income, you were also postponing the tax liability, and that creates another big issue that obviously we've talked about in the past but we're not going to be discussing today. So because of the fact that now you're in retirement and not employed, you're not making contributions to your qualified plans, so you're not going to be able to take those deductions. And then last but not least, charitable deductions that you were making while you were employed. See, while you're employed, if you have a charitable mind, you may be giving money away to charity. My experience has been that once people retire, they either start shifting from making financial contributions to a charity of their choice to making time contributions. So now, since they're retired, they have the ability to participate and donate their time, but the IRS does not give you a tax deduction for your time. So from that perspective, that's also not deductible. So when you factor in all of the different credits and deductions that you could have gotten in retirement because of the fact that you thought you were going to keep them, now you realize that even if taxes were not to go up in the future, which obviously we understand that they will, your tax liability may be higher because you're losing all of those deductions. Now, for 2018, for those of you that are now considering doing your taxes, if you happen to be married filing jointly, the tax brackets have been reduced. So not only have the standard deductions gone up, from $12,700 in 2017 to $24,000 in 2018, but also the tax brackets have been reduced. So you have the 10% tax bracket. The 15% tax bracket is now the 12%. The 25% is now the 22%. The 28% tax bracket is now the 24%. The 33% is now the 32%. The 35% actually remained the same compared to the old law. And then the 39.6 tax bracket is now the 37%. So you're also going to find that not only are you going to be able to hopefully maximize your standard deduction, but by the same token, your tax brackets are lower, so the tax liability should be diminished compared to 2017 if you maintain the same type of income on one versus the other from that perspective. Now, capital gains, obviously, it's, if you have the ability to pay capital gains rate, you're going to be better off because, the U.S. government and the IRS does give certain benefits to individuals and companies that pay capital gains, because the only way that you can pay capital gain is if you have actually placed and put your money at risk. So if you have a susceptibility to a capital loss, then obviously you also have a susceptibility to a capital gain and then be taxed at a different rate altogether. So from $0 to $77,200 of taxable income, your capital gains is $0. From $77,201 to $479,000 of income, your capital gains bracket is at 15%. And then anything over $479,001, then your capital gain goes up to 20%. So, one of the fallacies that we get from clients when we interview them from a tax planning perspective is that they feel that capital gains taxes are in the 20%. Only for those of you that have a lot of capital gains coming in excess of $479,001 will actually pay 20% on a portion of that tax liability. Now, as I said earlier, the deductions have actually gone up significantly to $24,000. Now, you did lose your personal exemption. So, if you have multiple children and you are taking a personal exemption for them, then perhaps the 2018 tax law may not be as beneficial. But for the vast majority of clients that we engage, in which their children are no longer part of the equation because they're either gone or out of the house or they're way too old for them to be able to take any credit, then the new tax law would be beneficial because of the fact that the deductions have actually gone higher. So that means that the zero tax bracket, yes, there is a zero tax bracket when you file your taxes, is actually wider than it was in 2017. Now, for those of you that are getting closer to retirement and that start to worry about, what is known about required minimum distributions, which we've talked about in the fact, it means that if you have any type of assets in a qualified plan, whether it's a 401k, IRA, a SEP, or whatever it may be, once you hit the age of 70 and a half, you're not going to have any choice but to start taking distribution out of those accounts, whether you want or not. See, when you started to put money away into your IRAs and 401ks, you actually went into a partnership with the IRS. And the problem is that the IRS gets to determine every year what percentage of of your assets they're going to take. So you have no control over that unless you do actually proper tax planning. And most important, they are the general partners in that partnership, so they have full control of making all the decisions that they deem necessary when it comes to your retirement distribution planning. So let's say, for example, that at the end of 2018, you had $500,000 combined in all your IRAs. Well, that means that under the uniform lifetime calculations that you need to do once you get to age 70 and a half, then you have to use a formula that takes a fraction, in this case 27.4. So you take $500,000 divided by 27.4, and the answer is $18,248. So that means that for 2018, if you turned 70 and a half in 2018, or in this case, as of the end of 2017, then you must take $18,248. Now, you can take more, but the least that you can take is $18,248. If you take less than that, then any amount that you should have taken that you didn't take will actually have to be taxable to you. But in addition to that, there would be a 50% penalty for failure to distribute the right amount of money. So that means that if you turn 70 and a half in 2018, you would look at the calculations as of the end of 2017, or whatever the value of your accounts were on December 31st, 2017, and then do your distribution in 2018. If you turn 70 and a half in 2018, you could take the distribution in 2018, or actually wait until April 1st of 2019 in order to take that distribution. The problem is that if you wait, and it all depends on your tax planning and the reportable income that you have for tax purposes, if you wait until 2019 to take your 2018 original 70 and a half distribution, then in 2019, not only will you have to take that 2018 distribution by April 1st of 2019, but also you would have to take the 2019 distribution no later than December 31st of 2019 as well. So it's a very critical issue for you to know what the rules of engagement are as you get closer to 70 and a half in order for you to do proper planning. Now, one of the main reasons that I'm going to spend time on this webinar is that I want to educate many of you, in how to actually take money out of your IRAs and your 401ks without having to pay taxes. Now, you would wonder, you say, well, Bert, if IRAs and 401ks happen to be in the tax deferred bucket, which we've talked about quite a bit, in which the money that goes in is pre-tax, the money grows tax deferred. But then when you pull the money out, you have to pay taxes on the whole thing. The answer is yes, you're correct, unless you've done proper tax planning. Because when it comes to your retirement distribution planning, see, not all income is created equal. So one of the many challenges that I see clients dealing with is that the vast majority of their Social Security benefits is being taxed in retirement. And the reason for that is twofold. See, when you're in retirement, most of us that do tax preparation will do a provisional income calculation. And provisional income calculation is a calculation that the IRS does in order to determine what percentage of your Social Security benefits are going to be taxed in retirement. In a perfect world, that number should be zero. In a not too perfect world, up to 50% of your Social Security benefits would be taxable. And in a really bad world, up to 85% of your Social Security benefits would be taxable in retirement. Now, if the only income you generate in retirement is from Social Security sources, then you don't pay taxes on your Social Security benefits. So the taxation of your Social Security benefits is not based on the Social Security income per se, but it is based on a combination of all the other income that is reportable for tax purposes in the given year. So for instance, the provisional income calculation takes into account 50% of the Social Security benefits that were paid out to you and your family in your surviving spouse for the given year, if you're married filing jointly. To that, they're going to add your ordinary income that you're reporting for the year. So any income, part-time income, W-2 income, 1099 income that you may have had, any distribution from your IRAs and your 401ks or your pension plans will form part of that calculation and report it as ordinary income. The IRS is also going to take a look at all the dividends and capital gains that you may have distributed during the year. So if you sold a stock or you sold a piece of property or whatever it may be, that's going to come into the calculation. And then last but not least, non-taxable interest, which comes primarily from the interest that most Americans generate when it comes to municipal bond funds. Now, I know you may say to me, Bert, you know, our municipal bond funds come in federal income tax free, and the answer is yes. But the problem with municipal bond funds is they're not totally tax exempt. Why? Because if you don't do it the right way, and you happen to live in a state that you do pay state income taxes, you may actually be susceptible to state income taxes. But on top of that, that income that you generated federal income tax free will also have a negative impact on your provisional income calculation and your Social Security benefits, because it has to be added onto the calculation. And then, you know, what would happen if you own a municipal bond fund, and when you sell that municipal bond fund, there's a gain in the value of that fund? Well, that gain may also be taxable to you as a capital gain. So although municipal bond funds are received on a federal income tax-free basis, they're not totally tax exempt because they will have a negative impact on your Social Security benefits and may have a negative impact on your state income taxes and or your capital gains taxes. Now, because of that reason, the IRS, in putting together the provisional income calculations, they have also created certain thresholds that if you don't go above and beyond those thresholds, and obviously you may not have to pay taxes on your Social Security benefits, but if you happen to go above those thresholds, then a large portion of your Social Security benefits may also be taxable as well. So if you're single and all of these calculations amount to less than $25,000, and you pay no federal income taxes on your Social Security benefits. But if that income is between $25,000 and $34,000, then up to 50% of your Social Security benefits may be taxable in retirement. And if your income under the provisional income calculation rules exceed $34,000 and you're single, then up to 85% of your Social Security benefits will be taxed in retirement. Now, what would happen if you're married filing jointly? Well, you have a little bit more leverage, but not that much. If your combined provisional income calculation is less than $32,000, then you pay no taxes on your Social Security benefits. Between $32,000 and $44,000, up to 50% of your Social Security benefits will be taxed in retirement. And if your provisional income exceeds $44,000 and you're married filing jointly, up to 85% of your Social Security benefits will be taxed in retirement. So obviously, when it comes to retirement distribution planning, not all income is created equal. As a matter of fact, there's an exercise that I will go through on Wednesday to actually show the fact that not all income is created equal in retirement. So for instance, in one scenario, we have a husband and wife that are generating $40,000 in IRA income distributions every year. And they're also generating $20,000 in Social Security benefits for a total of $60,000 of income. Now, that family, once they look at their Social Security benefits and the other taxable income, and they take their standard deductions or personal exemptions, they end up with a net taxable income of $24,500, in which they have a federal income tax liability of $2,559. But then again, if we were to do a calculation inversion, and we actually invert the numbers, instead of being a $40,000 of IRA distribution, it is $40,000 of Social Security distribution, because the second spouse decided to start taking Social Security benefits in order to offset their tax liability. And instead of taking $40,000 of IRA distribution, now they're only taking $20,000. So again, now they still have the same $60,000, except that now $40,000 comes from Social Security and $20,000 from IRA distributions. Then after they do all the standard deductions and personal exemptions, then their tax liability for the year is zero. So again, we still have the same $60,000 of distribution, same two families generating the same income, but family B in this case has a 0% tax liability, where family A has to pay $2,559 of taxes at the end of the year. So, that's in excess of $200 a month. What can you do with an extra $200 a month? Well, that could be obviously a car payment, that could be a savings, that can pay a light bill, that can be set aside for a gifting program, that can be set aside for a mini vacation, that can be set aside for additional savings and investments. So again, if you don't understand the rules of engagement when it comes to retirement distribution planning, then chances are you're going to be paying more taxes in retirement than you need to, and you're going to be susceptible to a higher degree of tax liability than someone that has done proper planning. Again, as we approach at the end of this podcast, I always like to share with you that, if you care for more information regarding any of these topics that we're talking about today, and or any of the topics that we cover every single week on our podcasts, feel free to reach out to me. You can call me at area code 786-766-1042. You can also email me at Bert at GablesTaxPlanningGroup.com. Again, let me repeat that, Bert, B-E-R-T, at GablesTaxGroup.com. You can also email me at Bert at bertsalazar.com, and I'll be more than happy to schedule a 30-minute video conference with you and address any issues and or concerns that you may have for your 2018 tax planning and beyond from a business perspective. So again, 786-766-1042 or Bert, B-E-R-T, at GablesTaxGroup.com. And again, I want to leave you with one final thought, which I always leave each and every one of you every single week, is that at the end of the day, my number one goal is to kind of help all of you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, have a great day, and we'll talk again next week. Take care.